Hello traders, Michael here. Gonna show you some money management. Money management is absolutely one of the most important things in crypto and any kind of trading if you want to make some money. Basically anything in life. If it involves money, if you don't manage it well, it's not gonna grow, it's only gonna decrease, right? So this video is just to kind of show you different types of ways you can manage your money with crypto and trading to make sure that you're not going to be losing your money. And if you do lose a little bit of money, your risk is going to be very small. So first things first, I'm going to list out different types of ways you can manage your money. So, oh, my microphone just fell. So for one of the ways is DCA. This is dollar cost averaging. Right, okay. I'll go over that here in a minute. The next way is setting take profit and stop loss on your trades. Okay, so setting take profit and stop loss doesn't sound like money management, but it's huge for money management. So that's definitely very important. Next one is knowing how much you're risking. Not necessarily knowing the exact size of trade you're placing, but knowing, how much it could potentially be going down. I mean, realistically, any coin could go down to nothing and you could lose all your money. And you got to kind of think that. But we can also check levels on the coin that you're trading to see, what probability it is that it might actually go down a certain amount if you were wrong on the trade. So knowing your risk, dollar cost averaging, take profit, stop loss. Another one is diversity. Okay? That's not putting all your everything in one pot, you know what I mean? That's that's basically spreading it around so you're not going to be all in on anything. So if that coin decides to drop and just crash, then you're out. You know what I mean? You ain't got no money left to use. So if your money is in, 10% of your money is in that coin, and you have 10% elsewhere and 10% elsewhere, and if one of those coins drop and, it drops 50%, you're only down 5% on your whole capital, right? But I'll explain that more here in a second. So let's talk about dollar cost averaging first, okay? Dollar cost averaging. What is that exactly? All right, so say you go into a trade, right? And you want to do 10% on the trade for the first trade. Okay. Say we take a trade, or I'll go back. Say we take a trade right here for 10%. Okay. And if we took a trade here for 10%, and the price decides to drop, that's not good, right? But if we take a second trade on the same coin, for another 10%. Can't type today. Second trade for 10%. Say at this level, right? So our first trade was up here at 44. Our second trade's down here at 40. So first trade, say, is at 44K. Second trade, 40K. So we place the trade for 10% at 44K. It drops about 10%. So now we're at negative 10%. And now we're at the second trade here at 40K. And so realistically, we're down 1% on all our capital. So 100% capital, say, is $1,000. Your capital, say, was $100, and it lost 10%. You're down $10. Okay? So if you're down $10 out of $1,000, you're only down 1% realistically, right? So now our next trade is at 40K, and we're at this level, and it decides to drop again. So now we're down to 36K. So we take another one for 10%, third, at 36K, right? $100 on the second trade. So now the second trade is down about 10% as well. So we're at negative 10. And this one's now at negative 20 and down 20%. Right? Okay, so now that we're at our third trade down here at 36K, place the trade again for $100. But the price went up. It went up to almost 40K, right? Let's see. Yeah, almost 40K. So we'll just put in there, it profited, right? Now we're up 10%. And now we're plus 10. And since the trade came back up to 40K, we're about even on this trade. Following me? So now this trade's at 0%. And this trade's at negative 10%. So here we broke even. Overall, we're at 0 now. And we started the trade all the way up here, right? And it came all the way down and then came back up. So it's not quite the 40K, so we might be down at maybe $1 or $2 on this trade, which would make us down maybe $1 or $2, which would be under 1% on the whole capital, right? So that's a really good way to minimize risk. So we had a huge drop here, yet we're not down much on the trade overall, right? And scroll back a little bit and make an example. Say we got in here at 47K, and then we got in here at 42K, which is about a 12% drop. And then we got in down here on the third trade, which is about a 15%, 16, 17% drop. And then it climbed all the way back up to almost our first trade. Now, since we broke even, when it hit the third trade and it came back up to the second, we broke even. If this trade is going into profit, this second trade right here, as we would have bought right here, now we're up here, everything's going to be in profit. The only one that's in a loss is this one. We're in profit on this trade and in profit a little bit on this trade, on the second one. So you minimized your risk on the fall and you took profit under your initial trade. So that's dollar cost averaging. You can, trade 10%, every 10% down, take a trade, first trade, second trade. Or you could do every 20% drop, you can take a trade. So it drops 20% and then you take another trade when it dropped 40% from your first entry and whatnot. So that's dollar cost averaging. The next thing I'm going to talk about real quick is diversity. So putting all your eggs in one pot, that's not good. So putting 10% is kind of another way to do this. We could have 10 trades going and we could have 4 that are not in profit and 6 that are in profit. And these, the 6 take profit and make money. And you're actually still making money on some of your capital instead of being stuck in one big trade, right? So doing 10% per trade or 5% per trade and doing 20 trades, it's kind of a lot of work, but you could start with maybe 5 trades and do 20% per trade. That's another way to minimize your risk. And then taking profit and stop loss is pretty important for when you have a strategy. So say we got in here at 4,200 and we wanted to make some money, right? It went up 5%, which is a fairly decent profit, right? But if we didn't take any profit, look how far it went down. Took a while to come back up, still didn't really get into much profit, maybe 5% profit from your entry here, and then it dropped again. And now we're here still stuck in a trade. But if we would have taken profit all the way right here, we would already be golden, right? So taking profit is really important. It kind of depends on what chart you're using. If we're using the 1 hour chart, kind of a range between 4-6%, sometimes 10% is good profit for the 1 hour chart, taking profit. If we're using the daily chart, we can take profit a lot higher. So as you see, the bottom was here, 36, and the top was here, 44, which that is almost 20% right there. So on the daily chart, you can be taking profit, between 10 and 20% to be safe. And taking profit, anything less, maybe 15 minutes. If you're using the 15-minute chart, this is even quicker. So you got to take profit, lower amounts, maybe around 1 to 3% on the 15-minute chart. So the lower the chart time frame, the less profit you should be taking to minimize your risk. And then for stop loss is very important too, because you don't want a trade to just fall and keep falling. Like if you got in a trade here, you don't want to be all the way down here. You want to have taken the stop loss somewhere around here to minimize that risk. And in my videos, I have, on my trading strategy videos, I have money management systems for you. But if you're trading on your own, make sure you have a stop loss and take profit system, or you're using DCA, or you're using lots of diversity. So that's it for this video. Thanks guys for watching. Stay tuned here for my trading strategies. If you're on my website, the video is right below that. And those trading strategies are gold. Get ready for them. Thanks guys. Michael's out.